One of the most important videos I will make all year. And it's the reason why I've just broken the market again. I'm beating the market and now $100,613 from $5,000 in under 3 years without doing options and without ever shorting a stock ever. So why am I up so much today when Nvidia is down nearly 3%? At the making of this video, precisely now, it's 2.4. It was down over 3% a few moments ago. Very, very important. A few people are making some major mistakes here and missing out on some major opportunities. And I've been saying the same story now for 18 months. Rates are coming down in the summer, and we are the summer until I think the 21st of September. I'm going to be 100% accurate with that. I've got no doubt about it whatsoever. But let me explain why I'm up today and Nvidia is down so much. I should be down. I should be down, right? Because Nvidia, the Magnificent Seven, I've got people in the channel right now telling me that I'm in the S&P and I'm down. How can you be up so much? I'm up 0.41 on my Roth, which is no margin, of course, all S&P, but I'm up 0.53 on my main account, beating the market. How can I be up that much? Well, there's two reasons. One, I'm beating the market because I'm in my margin, but more importantly, this is what's important, is Nvidia today and Microsoft. Very, very simple strategy. It's not hard, but it's being missed by so many people. Let me share with you on the screen right now. Nvidia is selling off and people are going, oh, this is terrible. It's crashing today. It's up thousands and thousands of percent, right? So down a couple of percent today is absolutely nothing, right? The reason it's down is people are trimming off the top because they now know Nvidia is starting to top out. Now, it's a great business. It's going to continue for many years to come to be a great business. There's no doubt about that. However, it's grown so much, it's now having to trim off. But that still isn't the whole picture. There's much more to it than that. And this is why S&P ETFs that track the S&P, but that are tech weighted, are down today. Several of my viewers have said, it's down today. What's going on? Why am I down? And I'm following the S&P. You're not. You're following the S&P, but you're weighted towards tech. This is why you are losing on a growth stock today and why I'm beating the market and why I've got a long, long way to go as well. Let me explain. There is billions and trillions of dollars waiting on the sidelines, waiting to buy into the American economy. Now, remember, super wealthy people, and I know lots of millionaires, and I know a billionaire, right? Mark Cuban. If you are making serious amounts of money and you have serious amounts of money, you are a trader at that point. You're not an investor. You've already invested and made your money. Your money is parked doing nothing right now, just earning 5-6% or whatever. You can just park your money and make money. All right. You don't risk your money. The number one rule of Warren Buffett is don't lose money. Rule number 2 is remember rule number 1. Park your money. You've got billions and millions to lose. You're not going to risk it. There's no need. You've made all the money you'll ever need, right? So what you're doing is waiting for the next catalyst. The next catalyst will be interest rates coming down. But remember, they don't benefit the Magnificent Seven. Apple and Nvidia and Google and Amazon, they love when the rates are high. They can dominate the market, they can destroy the competition, and they earn lots of money on high interest rates on their uninvested cash. That time is coming to an end. The big caps are going to pull back. So you might say, well, why am I going up? Why am I beating the market? What's going on? Why are you beating the market so much? That's because the smaller caps and the mid caps in the S&P 500, not a growth ETF that tracks the S&P 500, those are about to explode because they have been stagnant for years and they benefit from rate cuts because they're borrowing money. They don't have so much cash. They benefit. And there are 493 of those sitting around going sideways for 2 years, waiting for this stimulus. So those with big money are sat on the outside, no need to risk their money, waiting for that announcement. I'm not waiting for it because I am a long-term investor. I'm already in, and I'm already in with margin. What you're hearing on the news, 1 minute the rates are up, next minute the rates are down. We've all watched Bloomberg. We've all watched CNBC. They want to appeal to everybody. They are TV channels trying to get you to watch. You might say, well, I'm a TV channel, YouTube TV channel, and I want you to watch. Yes, I do, but not at the sacrifice of trying to appeal to everyone. I don't care. I hope you subscribe to me. I hope you watch, because I want to grow the best, most honest channel in the world, and I want to help as many people as possible. But I'm not going to tell you what you want to hear because you'll watch my channel. Either we're all going to get rich in 5 minutes, or we're all going to lose money in 5 minutes, or join my cult following because FFIE is a great business and we're all going to make money. No, it's not. It's rubbish. It's going to zero. If you're following cult followings telling you you can all get rich by buying rubbish, this is not that channel. So the reason why I am up so much today, we are going to get a rate cut this summer, 100%, no doubt about it. And that is until middle of September. So you watch and see if I'm right. I'm 100% certain of it. I'm in, not with my own money only, but I'm also using margin. There you go. I've reduced from $28,000 of margin down to 21. I only pay interest on 19 because 2,000 of it is interest free as on Robinhood. As a preferred gold customer, I get $2,000, not just the 1,000. So that's why that is. And what I'm doing now the markets are rallying, I am simply but paying down my margin. I'm not buying on the way up. I buy on the way down when there's external macro conditions that isn't detrimental to the value of the company, just external noise. Elections, Donald Trump said the world's going to come to an end. The invasion of Iran to Israel. These are all external. They're nothing to do with the companies themselves. So we have got billions of dollars waiting on the sidelines, waiting to come into the markets. They're going to come out of bonds. They're going to come out of interest-paying accounts into the markets. They're just waiting for the signal. The mega caps are going to fall, like we've seen today. I've shown you Nvidia today. Nvidia now is falling. So when you think that Nvidia, and some people say, will make up 15% of the gains this year, that is all baloney and nonsense. It's to drive the stock up and up and up. The stock is a great stock. It's a great business, but it can't run and run forever. And it doesn't matter to me if it trims off. It does to you in an S&P growth ETF. It certainly does, because you're heavily weighted towards tech. However, if you are in a balanced portfolio with exposure to the mid and small caps, they're all about to take off. So even if Nvidia goes down 10%, it's not going to bother me. I'm still going to beat the market, and I'm still going to make money, and I'm still going to get to the 100,000 by the end of the year. Oops, I did that 6 months early, and I'm still going to get to $250,000 within 4 years and $1 million within 6. That's still going to happen. All right, there's no doubt about it, because I'm an investor, and everything is calculated and balanced, and there's no emotion and all the rest of it. So that's what's happening today with Nvidia. That's what's happening with the news. That's what's happening with FFIE and things like GameStop. All of the meme stocks are coming to the end, and real businesses now, the smaller caps, the mid caps, are all about to take off. And the S&P, in my opinion, and I'm being very conservative about this, has a 8% growth left in it this year. And by the time we get to the 8% up, I would have paid off my margin waiting for the next pullback. Tom Lee, Wells Fargo, some banks say there is also a 20% left in the S&P this year. I think that's stretching it a bit, but it's possible. I'm really just focused on what makes sense, on the numbers that I can see, not the numbers that we hope to see. I think that's a better way of investing. Anyway, click above my head for all the links down below in the description. Over here and over here, I'll put more videos that you might enjoy in the series. Until next time, take care of yourselves and each other.